Good afternoon, this is Ken Long from Tortoise Capital with a review of the weekend trading plan and reports for December 15th, 2012. We have a market that's still in bullish normal. It's neutral on an annual basis, looking at weekly RSI 14, 55 out of 100. On a 10-day NDX basis, the short term, it's also neutral at 42 out of 100. Percent stretch relative to the 200-day moving average is red bullish at 2.82%, so we're 0.82% away from sideways markets. Slope of the 50-day moving average is yellow neutral at minus 0.12. ADX is at a very low 11.6, so non-trending market. Volatility measured by ATR percentage remains under 1 at 0.89%. No change to the blended monthly rebalancing. The 13 and the 26 ETF portfolio both favoring overseas equities. No change to the ETF2 model. Theoretical exposure is 80% and the model portfolio is 80%. This link will take you to about a 10-minute review of half a dozen short-term trades from the chat room. Quick look at the ETF blended monthly rebalancing portfolios. Again, you can see it dominated by the globals, and with the U.S. and commodities suffering, especially U.S. tech in very bad shape. Next up is the market health check. Vertical blue lines are 10, 20, and 30 days of look back. Horizontal purple line at 147 and some change is the swing high from back in October. And the support level at 143, where we're currently hovering. The red lines are the support and resistance lines of the past 4 months. You see the dark blue shaded river with the red Bollinger Band mean in the middle. That's 30-period Bollinger Band plus or minus 1 standard deviation. I've added what I'm thinking of as the floodplain as the lighter shaded blue area. That's plus or minus 2 standard deviations. The red shaded area is the 200-day moving average and the price action below it. Central black line is the 30-period regression line. And the outer 2 black lines are the channel that are formed by the maximum excursion from that regression line, which happened at the start of November. So you can see right now that we're price is above the 10 period, the 50 period, and the 200 period moving average. It got just past the 1 standard deviation mark, stayed inside the floodplain, and now is rolling back towards the mean, which is the thick red in the middle. The thick black line, the curving line, is the slope of that 30-period regression line. When that crosses the 0 line, that usually is an indicator of change in direction of the primary trend. You can see that the last time it did that here, market went on a 20-day downturn, found a peak or a bottom down here, has been steadily improving across the 0 line here. That would have been a natural place for hesitation. And what has now become the middle of the river. Now it's on a leg up. So we've got a tactical trading market between 147 and 135. It's about a 9% channel. It's got to get above 147 and close above 147 for a true resumption of the bull. You can see the ADX has declined down to 11. The jaws of PPO are closing as far as the upturn has seemed to have run its course. On the intermediate term trend, this is now crucial. What happens here in this area around 141, 142? Is this going to be a base that can support another leg up, or is that going to be resistance? So we'll see that in the days ahead. So this is still a tactical trader's market. The one thing we can say from ADX being this low is that that's often a time for it to for the start of the next intermediate term trend, which will have time to unfold, given that it's been a pretty choppy sideways trend. I've included this form of the chart. This is also a form of the health check, but I'm using freestockcharts.com and exploring that as an alternative to stock charts. And you can see the +1 and +2 boundaries of the river here. The thick red line is that Bollinger Band mean. I've included the regression channel. What I've noted in yellow circles are all places of interest where the ribbon held support at the Bollinger Band mean. That orange ribbon represents a 2-period Bollinger Band. We had a regression line crossover here and here, and then price leaving the river, making a nice run. A regression line crossover here outside of the river. Normally we're expecting a pullback and find support at the Bollinger Band mean. That's the first price target. It held when it left the river. Another regression line crossover. Price leaving the river again. Gives you a nice leg up. Here's a regression line crossover outside of the river, comes back to the Bollinger Band mean, then makes a series of lower highs and lower lows. And when the 30-period regression line in white crosses the Bollinger Band mean, change of trend, and then a sharp downward move. You can see it in a couple places where price has left the river and a regression line crossover occurs. Now we're at the front end of a regression line Bollinger Band mean crossover here, so that's potential. I am holding up some hopes for an upward move here. So I kind of like the freestockcharts.com. I like that it gives you the regression lines that can be plotted with ease. Very flexible platform. ETF2 regional report. 2 of the indexes, both in the U.S. U.S. large caps and tech, are both on cash. That's the other 8 are on a buy signal based on the moving average filter. And that's what keeps us at 80% invested, 20% cash in the model portfolio. EFA at 66 is better than SPY at 60, better on a strength basis too. So it's the globals doing better than the U.S. Inside the U.S., it's mid caps, then large caps, then small caps, then technology. The 2 strongest sectors are Europe and Asia less Japan. The 2 weakest are U.S. tech and U.S. small caps. World market model, everything U.S. is below average with the exception of the mids. Asia less Japan dominating. Selected leadership in Asia with Australia, Hong Kong, Singapore, Korea. Mexico is strong in Latin America. Anything Europe is above average or exceptionally so. You can see that the global finance and global healthcare dominating the U.S. In just about every case except for energy. The global business sector is dominating the U.S. business sector on a relative basis. Thanks, girls. Top 30 ETFs in the ETF2 database sorted by strength. It's China, Austria, Mexico, China, Hong Kong. U.S. home construction has come down off the top, so a little change. Inside the Dow 30, sorting by relative strength. Bank of America, Travelers, J.P. Morgan, so 3 out of the top 3 are financials. And again, the producers are at the bottom: Hewlett Packard, Intel, DuPont, Microsoft. ETF liquidity, you can see how much volatility has come out of even the VIX. It's down to 3.75% relative ATR percentage. We'll shift ahead now to the daily. No signals in the channeling or overreaction system. You can see how much volatility has come back now to low normal. ADX very weak. Lots of signals in the auto framer that test out well just based on trade location. You got a 551W in ExxonMobil, 5 days down in natural gas, channeling in treasuries, and then channeling an overreaction in Home Depot, Walmart, and Merck. Home Depot tests out at 4.7 on the auto framer. That's good. You can see max pain range compression, the top 5 candidates. Home Depot, Walmart, Merck, AT&T, and Boeing. Here's your Doji and a 551W and ExxonMobil. I like Home Depot and Walmart and United Technology because of the low RSI2 score. Home Depot looks very interesting to me here. It had been a 3, 6, and 12-month winner, still is compared to its peers. Only one symbol has done better in over those periods of time, yet Home Depot has pulled all the way back to $62 and is now number 1 in the max pain range compression, and that one looks like a buy on dip opportunity if I ever saw one. Inside the ETFs, many more hit the 2-to-1 threshold for the auto framer. And you got here's your channeling and overreaction signals in silver, and then a number of 551Ws and consumer staples, Russell small caps, and the S&P energy. Natural gas should be looked at because of the RSI2 score as well of 1, as should gold. Consumer staples looks very interesting to me there with a 9 on an RSI2 and a 551W. That's going to give you a good reward to risk ratio. Market mosaic. 30-period regression line. You can see how the slope is still pointing up and is leaving its 10-period behind. It's already made a 3 standard deviation move up. And right now, with price respect to the 200-day, this is a place where you would expect some choppy price action here, but it's made a nice move off the bottom. And now here's a chance for it to get the next leg up. So we are ready for either direction's move in the week ahead. Z-score of the regression lines, you can see the 30 has continued to respond, is nearing the top of the channel. So this would be a natural place for it to fail. It's at the top of the river. It's had a nice 20-day run. It's been an exceptional move upward, and the market could go equally large in either direction. Reference data file. And no special comments on any of these. That's the weekend trading plan for and report review for the Tortoise and the for members in the weekend webinar. We'll be going over some of the detailed charts and trading frames for the week ahead. So good trading and keep your risk measured.